Hello, this is Professor Enrique and welcome to your session. This session will be devoted toward understanding for indirect investment, understanding the challenges when it comes to foreign direct investment. This topic is covered in International Accounting course and International Investment course, and it has some content that has been it's very interesting and a very interesting topic towards the CPA course and for accountants. But remember that the purpose is not to make you accountants. As I always tell you, don't forget to add me to the YouTube channel so you can have available all the content for your course in my YouTube channel. Please subscribe to my channel and like them so you can have everything at your hand. So how would you conduct for a direct investment is when you own and control a foreign asset. The very used example is a US company base that owns a share from a foreign company. How would you do it? You would buy an existing company, you would buy another manufacturer, another retailer, another software, or you would invest what it's called invest in an existing operation, or you would start your own company, and it's called greenfield investment. It's you will start your own branch over there. Those are the two ways to do foreign direct investment. So how would you do it? It would depend on what is your objective, what are your resources, if you study the market that you're entering, if you have your net present value analysis to make sure it's worth to move to that country or to that territory. And what are the reasons for indirect investments? Obviously, it's to increase and sales and profits. You will have a larger market where you can sell more. You can have a new technology. You would like also to enter to rapidly to a growing or an emerging market. So, for example, the rate of growth it could be higher than your own country. So you want to gain a foothold because, generally speaking, the earlier you start something, the better are the results in a business. Why? Because you're newly started, you have experience, people it's coming to you, and generally speaking, you will have a foothold. Another reason to enter is to reduce costs. You might be able to get your production closer to your suppliers, shipping product, shipping components that obviously can make you substantial savings by lowering the cost of transportation. It could be cheaper to operate those. So gain a foothold in economic blocks. What are the economic blocks? It could be NAFTA. It could be the EU. It could be the Asian bloc. The Asian bloc is China, Malaysia, and And once you get a foothold in there, then you would have access to the whole block. You want to reduce restrictions on your product, or you might be able to remove some import tariffs. So another way to move overseas is to protect domestic markets. In order to penetrate the market, you would weaken international competitor by entering to the home market of your competitor. Now they need to defend their market. They need to destine some funds in order to protect from your investment. So this is a very strategic reason to enter for indirect investment. So and and the last one is you want to acquire technological and managerial know-how. Maybe conduct research and development at lower cost and hire experienced employees from competitors. Now, obviously, we have challenges or difficulties for foreign direct investment, and this is a list a list of all the challenges. Well, some of the challenges. And the first one is financial reporting for foreign operations, international income taxation. We will go over each of these topics, so don't worry about it. I will explain them furthermore. International transfer pricing, performance evaluation of foreign operations, international auditing, and sustainability reporting. So the first one is financial reporting. So what does that mean is we need to translate and we need to convert our financial operations to US or maybe to Mexican pesos. It would depend totally on the investment perspective, the investor perspective. If I'm the investor and I invest in US, I would like to see my financial statements in US dollars. But what happens if the foreign company it's in Mexican pesos? Then we would need to report those Mexican pesos into the US dollars so I can understand them. So the steps is to convert from the local accounting to the US accounting method. We have to prepare your financial statement to using the US GAAP, which is the accounting principles for the United States. So we also would have to translate from the local currency to the US dollars. Records are prepared using local currencies, like the example of the pesos, the Mexican company, that it's all its accounting database is in pesos. So I would have to translate them into US dollars. This is just an overview on some of the challenges that you will have with foreign direct investment. Another challenge is international income taxation. The question is, how much taxes have to pay in local and home jurisdiction? For example, if you're a US company operating in Mexico, what would happen? We will have to pay taxes in Mexico and taxes in the US. What does that mean? You will have double taxation. So you will have foreign income taxes. The company, we will have to pay profits tax at foreign rates. And then the US, you will have to pay the company's foreign-based income. That means that you will have to pay. That means you will have to pay taxes additional to the ones from the Mexican entity. So we will see furthermore this topic, because we also have different tax treaties that provide some relief from this double taxation. So you obviously need to know what are the tax treaties and what are the taxes, what are the tax implications of moving to foreign operations. And what are our objectives is to legally minimize taxes in foreign countries and home country, to maximize after tax cash flows. Uh, Obviously, expertise in international taxation is needed. You won't be experts in this topic. We must take care of this area once you are running or managing a company. But why? Because, like for instance, the U.S. treaties can grant you some credits to pay less taxes, because you know that there's an implication in double taxation. Obviously, the tax treaties are not allowed always, and you have to investigate about them. Another topic is international transfer pricing, and before we see the slide, let me do some drawing. In here, we will see, for instance, a U.S. based company. Let's call it Tesla, for instance, and they purchase a company in Mexico because they are able to manufacture the cars or some car components on a cheapest way than it would be from the US based company. Okay, let's do it at this example for a Tesla model. Just one model, it's cheaper to manufacture in Mexico. So what would you say if this car, if it's your company, because remember, this is Tesla USA and this is Tesla Mexico. What if the US based company purchased this car at 0 pesos, $0? They can purchase this for $0. So the income that they charge to the customer, for instance, like 100, decreased by the cost of 0 pesos, would increase all the revenues in the US based company. And what would happen to the Mexican company? They will have no income. But obviously, they will have all the cost, all the manufacturing costs for the car. So they would incur on losses. The Mexican company would incur on losses. So how much taxes or how many taxes they would have to pay to the Mexican government if they have losses? You're not obligated to pay taxes when you have losses. You pay taxes on the profits in the companies. So obviously, all the tax would go to the US based company, and they will pay all the tax in the USA. And the Mexican government wouldn't be able to charge anything from that operation. So in order to avoid these kind of situations and diversing or directing towards other countries all the taxation that it's generated for business operations, the governments have created the transfer pricing. So basically what they are doing is, in order for these operations to occur, they would have from subsidiary to the parent company, like in this case, they would only are allowed to charge on a market-based pricing. Market-based pricing. That means that This Tesla model, we can find a way to know the market price of that model, and the Mexican entity would be only allowed to sell to the US-based company based on the market price of that model. That is what is transfer pricing. And why? Because maybe we're not allowed to sell to the 100 as we did in this case. But what if we purchase below that figure? They still, the US based company still would be having a benefit from making the operation in Mexico, because they are manufacturing at a lower cost that they are doing in the US based for that specific model. But Mexico wouldn't be having losses, because they have to sell at a market price. So they will tax something in Mexico. That's the transfer pricing. So we will have a whole chapter regarding the international transfer pricing, but the issue for multinational companies making intercompany sales. So companies use discretionary transfer pricing, and discretionary transfer pricing is what they want to charge. The price negotiation between buyers and seller not feasible due to tax rate differences. So what's gonna happen is that we would have to find the best way to reduce the taxes. So companies shift profits from countries with high tax rates to countries with low tax rates. It's not the same example that we saw, but imagine that's why we have how do you say, it's tax paradises, because they have lower tax rates than most of the countries. So investors are incentivized to diverse all the utilities towards those countries with lower tax rates in order to pay lower taxes. So the main objective of international transfer pricing is that countries regulate international transfer pricing to ensure that companies pay their fair share of local taxes.